yesterday we got more evidence out that the U.S. housing bubble is continuing to grow and is back to 2006 levels. Also that the global everything bubble is just continuing to get worse across the board in asset prices. More and more red flags with real estate and housing in the U.S. and China, and I will talk about a number of those stories today on today's show. So, the largest amount of housing starts in 13 years. So for those of you who are not familiar with the official statistic of what housing starts are, the Investopedia definition, and if you're new and just learning about this stuff, I recommend bookmarking investopedia.com. What are housing starts? Housing starts are the number of new residential construction projects that have begun during any particular month. The new residential construction report, commonly referred to as, quote, housing starts, is, unquote, is considered to be a critical indicator of economic strength. Actually, it's of, like, getting the housing bubble going and demand for foreign investors like Chinese and Europeans who are bringing money here into the U.S. to buy housing or retire here, because on a relative basis, retiring here in California, Arizona, Florida is on a relative basis cheaper than retiring in many different parts of Europe. Housing start statistics are released on around the 17th of each month by the U.S. Commerce Department. The report includes building permits, housing starts, and housing completions data. Surveys of home builders nationwide are used to compile the data. If you want to read more of that article, it'll be in the information and description section later after the show is over. So, the CNBC report came out yesterday based on this data that home building surged to a 13-year high since it's the highest level since December of 2006. As you can see there on the chart, it is back to very, very high levels, but there are a lot of other red flags I'll talk about a little bit later in the show. But let's just talk about the housing starts. Housing starts spiked 16.9% to a, quote, seasonally adjusted annual rate of 1.608 million units last month, the highest level since 2006. CNBC reported yesterday. This follows a trend as recent economic reports showed consumer confidence at the highest levels in nearly 20 years. But I would say U.S. consumers are always overconfident. Very rarely does consumer confidence drops, because the first three letters in confidence are con, just like Congress. My personal belief is that Congress should have their spelling changed, and the first three letters should always be C-O-N, as in con artist, should be capitalized for Congress. To put the housing situation in context, CNBC reported that economists polled by Reuters had forecast housing starts would increase to a pace of 1.375 million units in December, so their predictions were off by a whole 233,000 units. According to the report, housing starts, so it just goes to show you that these economists making these projections are normally very, very wrong, but the surprise on the upside, the amount of housing being built, is nuts. And you're going to see why with another story in a little bit. There was an Atlantic story that came out from the Atlantic, because I source material from all over and I combine things on shows, and I don't see other people doing this nearly to the levels I do, that the Atlantic reported, Derek Thompson wrote an article a couple days ago on January 16th, that half of the luxury condo units that have been built recently in Manhattan in the past 5 years are unsold and empty. And the building is still ongoing. So according to the, and China's just as bad. I've seen stories, and there's new video proof out of China too that this is as bad or worse in China. According to the report, housing starts soared 40.8% on a year. Wow, that is nuts. Housing starts soared 40. It's highlighted in all black caps here. Actually, it's not caps. It's all bold. 40.8% on a year-on-year basis in December. That is freaking crazy. Housing starts 40.8%. Lower interest rates, lower mortgages, built on speculation. That is nuts. An estimated 1.290 million housing units were started in 2019, up 3.2% compared to 2018. CNBC provided further context. Quote, the housing market is regaining momentum after the Federal Reserve cut interest rates 3 times last year, and I will add to intentionally uninvert the yield curve, pushing down mortgage rates, even though Neil Kashkari will probably respond to that on Twitter because I called him out on it. Pushing down mortgage rates from last year's multi-year highs, the 30-year fixed mortgage rate has dropped to an average of 3.65% from its peak of 4.94% in November 2018, according to data from mortgage finance agency Freddie Mac. So I have I have two other articles on this if you want to read more into depth from different sources. U.S. housing starts at 13-year high. Factory output gains by Lucia Mutakani from Reuters. And then also by Don Jacobson of UPI, U.S. housing starts surge to 13-year high, government figures show. So if you want to read more about that, it is there. Now let me talk about misallocation of capital, these developers who are building on spec, and about some of the craziness now that's mirroring the first U.S. housing bubble, 2005, 6, 7. So there was a lot of mortgage-backed securities back then, predatory lending, there was home equity loans, there was jumbo mortgages, and there are stories coming out that the banks are more open now to this at higher housing prices. And locally here in the DC metro area, there's a California mortgage finance company, a financial service company that focuses on mortgage refinancing, home equity loans. And on the radio stations here, whether it's the pop radio, the top 50, the popular songs, or sports talk radio, they are running now. This has been this way for at least a month. They are running nonstop radio commercials, this Westland Financial here in the DC metro area, for home equity loans, telling people that housing prices locally are starting to not go up a lot, even though, according to my best friend, who is a very successful real estate agent at one of the top firms in the DC metro area, that inventories are actually collapsed. There is no inventory available on a lot of single-family homes in many of the major areas right outside of Washington, D.C. So that's why developers are building so many of these fancy multi-use buildings and teardowns, and people are adding on to their existing homes. They're renovating. They're paying more money to renovate. So inventory levels, and a lot of that's also the Amazon effect. So you have a lot of people moving here for a government job or for an Amazon job. You have a lot of speculators that are bringing capital into the DC metro area for real estate, and that has surged real estate prices on different data metrics, I think 25% in certain areas like Crystal City neighborhood, which is in Arlington County, which is supposedly right around where the Amazon headquarters are going to be, and the Old Town Alexandria area and other parts of it, which are, some areas are dilapidated. People are buying those areas on spec and tearing it down. But institutional bank analyst Christopher Whalen, he actually saw this coming on March 17th, 2019. He wrote a blog article about home equity loans and how, with real estate prices in many major metro areas in the U.S. were going up like crazy, that the home equity loans were going to start again massively. There was going to be a big spike in them again, that banks were more open to these home equity loans. His blog article was from March 17th, 2019. And he was talking about going to he goes to these really weird derivatives conferences. If you're not a financial professional or you're not a bank analyst, you wouldn't know a lot of the stuff that's discussed there because it's very wonky. But his insights on the institutional risk analyst are very, very good. He also recently just put out a blog article this week talking about how, in his opinion, he thinks HSBC Bank is in worse shape now than Deutsche Bank because of all the massive exposure HSBC Bank. Number one, they have really bad leverage ratios that he was calculating, and he explains it in his blog article this week, but also because HSBC Bank's exposure to the drastically overvalued Hong Kong real estate market, and also HSBC loaning massive amounts of money into mainland Chinese real estate. And on top of that, you have Kyle Bass, who's been covering things, rumors, and also the amount of upper-level senior executives that are leaving HSBC Bank, more specifically HSBC Bank's China unit. Kyle Bass just put out a tweet today, actually, I believe, saying that another HSBC Bank executive out of the China division, a senior one, just left. So that's about 5 or 6 of them that have left in the last 10 months. So that to him is a big red flag. And then you add in what Christopher Whalen is saying now, how he thinks, based on HSBC Bank's exposure to overvalued real estate in Hong Kong and mainland China and bad loans there, and how HSBC is reliant on real estate prices either staying at these levels in Hong Kong and mainland China or going higher, that HSBC has really, really bad exposure. The stock price in HSBC, I haven't looked at it in the last month or so, but it was slowly sliding over the summer, a couple dollars a share. So it was not rallying like some of the other bank stocks were in the past, in the last year or two. It had not had enormous rallies. So the official narrative at HSBC is that they've been doing restructuring. They were trying to increase the dividend. But there's been a lot of news stories out for HSBC Bank really since early 2019 that a lot of bank executives were getting in trouble. The China division, which is their most profitable, was in a lot of trouble with the Chinese government for a bunch of different reasons that I've highlighted on past videos. And then also, I think another HSBC Bank executive that was hired after a merger with another smaller bank in London, that guy's he was facing a bunch of criminal charges, and I can't remember if he killed himself. He either tried to kill himself or he killed himself. You know, the normal banker suicides that have been happening for a while now. So if you want to read about the home equity loan, how the mortgage industry and banks were already talking in 2019, and normally these big banks are pretty slow with policy stuff. So if they're going to start rolling out things like massive amounts of home equity loans and running radio commercials and TV commercials and coming up with marketing strategies to dupe people into doing this, normally it takes a year or more to get these things rolling. So this was being discussed early last year, and Christopher Whalen was documenting this at the conferences he was going to that were describing this. The other story I wanted to talk about the U.S. real estate market. So I talked about the local D.C. market and how the D.C. market is becoming ridiculously Washington, D.C. metro area. I've talked about this now for the last year or two with the amount of construction cranes here, how there's enormous amounts of tear downs with single family homes. People are renovating. That's also very expensive. But now the inventory levels with Amazon moving here to the Arlington area, I think Crystal City neighborhood specifically, that's just bringing in so much more speculative capital. But this article is from a couple days ago on January 16th. I talked about this a couple minutes ago briefly. Derek Thompson, staff writer at The Atlantic, why Manhattan skyscrapers are empty. Approximately half of the luxury condo units that have come onto the market in the past 5 years are still unsold. In Manhattan, the homeless shelters are full and the luxury skyscrapers are vacant. So I think there's a number of powerful reasons for that. It's not just one factor. Number one, you have what President Trump did with the SALT deductions, which are state and local tax deductions. And because of that, not New York City and New York area in general, specifically in the New York metro area, and also New Jersey, which is not that far, the New Jersey areas that are not that far from New York City, it is very, very expensive with taxes and cost of living to live there, and the costs go up and the taxes go one direction, they go up. So a lot of people cannot afford, their incomes are not rising unless you're a business owner or you work on Wall Street or you're a corporate ad executive or you have a nice high paying job. Because the cost of living, whether it's healthcare, taxes, other expenses are going up like crazy there. But President Trump removed, with his tax cuts, tax cuts that he put in, the Trump tax cuts, the state and local tax deductions in major Democrat states like California and New York City. The major cities in California and New York City, those were eliminated. So there's a bunch of stories, and you can use this in search, and I may try to find one later. I've read them now for a while about more affluent people in New York City and California who are leaving those states. People in New York City are going to Florida, and a couple that makes over $500,000 per year combined are saving over $100,000 per year on taxes alone just by leaving New York City, because they no longer have the state and local tax deduction. So you have that, but also with the increased amounts of capital controls in mainland China, it is not easily, more affluent, richer Chinese in the mainland are not as easily able to get their savings out of mainland China and park that in real estate in the US to go buy those luxury condos in New York City or in Australia, the major cities there. Probably a little bit easier to get it into Australia, or Toronto, or Vancouver. So all the crackdowns that the Chinese government has, most of the policy that the Chinese government has been doing for the last couple of years is to trick capital to come in, especially dollars to come into mainland China and not let it leave. And then also block the savings of mainlanders from leaving China. Oh, SALT was not eliminated, it was capped? My bad. I mean, it's very similar. It's very similar because they do not get to deduct it. So it's almost as if it was eliminated because now there's no economic incentive to stay there. So capped or eliminated is the same principle. They're still crushed now. There's no deductions. They don't get to take massive deductions on their federal income taxes. So a bunch of different factors are what is causing, and yet you still have these developers that are still building massively. So in Manhattan, such as the tale of two cities within America's largest metro area. Back to the article, even as the Atlantic article, even as 80,000 people sleep in New York City shelters or on its streets, Manhattan residents have watched skinny condominium skyscrapers rise across the island. These colossal stalagmites, interesting choice of words there, initially transformed not only the city's skyline, but also the real estate market for new homes. From 2011 to 2019, the average price of a newly listed condo in New York soared from $1.15 million to $3.77 million. So in only about less than 10 years, the price of a newly listed condo in New York more than doubled. But the bust is upon us. Real estate prices in mainland China have also soared in similar levels over the last 10 years. But the bust is upon us today. Nearly half of the Manhattan luxury condo units that have come onto the market in the past 5 years are still unsold, according to the New York Times. What happened, while real estate might seem like the world's most local industry, those luxury condos weren't exclusively built for locals. These luxury condos weren't exclusively built for locals. They were also made for foreigners with tens of millions of dollars to spare. Developers bet huge, so they bet on speculation with cheap interest rates. Again, this goes back to the Federal Reserve, allowing these developers to continue to build on spec. These developers are not building after they've collected deposits. They're building on spec, and in hoping that they can dump, like in 2005, 6, 7, that they can dump these units for a profit before the real estate bubble collapses again. Developers bet huge on foreign plutocrats, Russian oligarchs, Chinese moguls, Saudi royalty, looking to buy second or seventh homes in New York City. But the Chinese economy slowed, and also the capital controls, which this author did not mention, which are very, very important, while declining oil prices dampened the demand for pieds à terre among Russian, wow, he's really using fancy vocabulary here. He should not do that. Among Russian and Middle Eastern zillionaires. It didn't, clearly he does not like rich people. Didn't help. It is the Atlantic though, right? So the bias is going to be clear, but at least we're getting some interesting information for most of the article. Didn't help that the Treasury Department cracked down on attempts to launder money through fancy real estate. Despite pressure from nervous lenders, developers have been reluctant to slash prices too suddenly or dramatically, lest the market suddenly clear and they leave millions on the table. Or in the case of mainland China, where they literally cancel sales that are below market, where the Chinese government and local Chinese politicians cancel sales by real estate developers that are below market prices. The confluence of cosmopolitan capital and terrible timing has done the impossible. It's created a vacancy problem in a city where thousands of people are desperate to find places to live. From any rational perspective, what New York needs isn't glistening 3-bedroom units, but more simple 1- and 2-bedroom apartments from New York's many singles, roommates, and small families. Mayor de Blasio made affordable housing a centerpiece of his administration. Yeah, these politicians talk the talk and then they don't do anything. Again, central planning doesn't work, but these politicians always say one thing and do another. Republican or Democrat for the most part. There's very few politicians that do what they say. But progress here has been stalled by onerous zoning regulations, limited federal subsidies, construction delays, and blocked pro-tenant bills. The construction industry in New York City is ridiculous. Ridiculously corrupt, ridiculously inefficient, and ridiculously overpriced with permits and other stuff. Same thing with California. In the past decade, New York City real estate prices have gone from merely obscene to downright macabre. From 2010 to 2019, the average sale price of homes doubled in many Brooklyn neighborhoods, including Prospect Heights and Williamsburg, according to the New York Times. Buyers there could consider themselves lucky. And again, these buyers probably did not upgrade their property, plant, and equipment. The prices just doubled. So the homeowner didn't do jack shit. Didn't do anything, and the prices just doubled. So again, this is more irrational behavior caused by central bankers and flight capital leaving China. So the amount of money and credit, just tens of trillions, that was created in China, it has gone and been parked into real estate and caused global real estate bubbles, whether it's Vancouver, Australia, and also in the US. In Cobble Hill, another neighborhood in New York City, the typical sale price has tripled to $2.5 million in 9 years. Damn. That's crazy. Doing nothing to your house, although you're paying higher property taxes. So the governments benefit from this. So the local governments don't provide you any more new products or services. They don't upgrade the infrastructure. Many cases in New York City and elsewhere, the infrastructure is declining, and yet they're minting money on their property tax collections. So this is a big scam. If you're not aware, it's been going on for a long time. between the central banks, the governments at all levels, and real estate prices with the property taxes, even if the homeowner does not maintain or upgrade the property, the home, that the home prices are just rising, and then the government gets more, all levels of government get more tax revenue. So at the federal level, when the homeowner sells the property for a lot higher price, the federal government gets capital gains taxes, or unless someone does a 1031 tax exchange. And then at the state and local level, they're charging enormous property taxes on the higher home value, even though the homeowner did not make any upgrades. The home price still went up a lot. This is not normal, and for middle-class families, particularly for the immigrants who give New York City so much of its dynamism, it has made living in Manhattan or gentrified Brooklyn practically impossible. Also seeing this all over the DC metro area. I believe Prince George's County is the newest county now that's being gentrified. But if you've lived here for a long time, the Clarendon area was not very good 20-something years ago, and it's very, very expensive now. There's been enormous amounts of teardowns. There's mixed-use luxury apartments and luxury condos in Clarendon now. If you come here and visit me in DC for dinner or beer or something like that, I'll show you all the construction cranes and all the craziness here. Okay, well, there's a couple more things out of China. China's home price growth at almost 1.5-year lows. Further softening seen by Reuters article, January 15th. So things are, average new home prices in China's 70 major cities rose only 6.6% in December, slowing from 7.1% in the previous month. So home prices in China have gone up a lot. China has really bad stagflation in many major cities in food prices and rent. And there was a very interesting video a few of my contacts sent me that came out earlier this month exploring an abandoned Chinese ghost city from the Prosper People YouTube channel. So I'll put that video if you want to watch. It's 34 minutes long. It's got over 600,000 views. If you want to watch that, it will be at the end of the show, the last 30 seconds, the video link will be there. I'll also put it in the information and description section. So just even more evidence that the real estate bubble here in the US is inflated back to 2006 levels, with the home equity loans starting to be massively marketed again. Now, we don't have the mortgage-backed security levels anywhere near where they were in the past, but from speaking to my friend Wayne, who sent me an email yesterday tracking the repo madness, that now the large banks are starting to put massive amounts of collateral as mortgage-backed securities. He was telling me yesterday in emails that the amount of mortgage-backed securities used as quote-unquote good collateral by the banks for repo madness now, and repo madness has not stopped yet. The Federal Reserve's balance sheet, even though it dipped last week, is back up to the same levels it was 2 weeks ago. So it increased about $26 billion again. But Wayne was saying how the collateral that the Federal Reserve is taking is now heavily skewed. The quote-unquote good collateral the Fed is taking for repo madness is now heavily skewed by the big banks and others in the repo market towards mortgage-backed securities. He was saying it's at least 50% of the collateral is mortgage-backed securities. Aussie speculator says the local councils in Australia are addicted to higher property valuations so they can raise council rates that homeowners have to pay. So every year the council revalues properties as going up in value. Also, what I would add is that the taxpayer is not getting the benefits of better infrastructure, better schools. They're not getting that. In a lot of cases, that money is meant to maintain the status quo, and a lot of these government bureaucrats are paying themselves higher salaries, more perks. So those higher property taxes are not being reinvested into the local community for better infrastructure, as the claim is. There's no evidence that, in many cases, that the infrastructure with higher property taxes is improving. It's meant to maintain the bloated local government budgets without cutting the budgets. So these government bureaucrats, here in the DC metro area, go off on a little rant here. Here in the DC metro area, there are so many government employees at the federal, state, and local level that make more money in average salaries and get pay hikes and get Cadillac Healthcare and get cushy retirement investment packages. They make double the amount of money in many cases, starting salary, as an entry-level employee at a private sector job. And they can't be fired. You will not see that in articles. You will not see that in any statistics. They intentionally will not cover this. But if you lived in DC long enough, you know. Anyone earning the salary levels of a federal government employee making like 80 grand or 120 or 150 grand per year, any private sector employee working at one of those consulting jobs has to bust their ass. They are working 100-hour weeks. They're getting up at 3 a.m. for conference calls to India or elsewhere, or traveling all the time. I know former consulting employees who have burned out, who've gotten sick. They can't handle that type of work for long. Meanwhile, you have federal government employees, state and local government employees around here, and defense contractors who brag to me after a couple drinks normally at the bars in the past. I don't go out drinking that much anymore, but I used to go to charity events and bars, bragging to me that they make $100,000 or more, and some of them don't even have to go into work. Tell me that system is sustainable. Please tell me that system is sustainable, because I don't see it sustainable at all. Where government employees cannot get fired, making way more money. So why do you think everyone wants to move here to the DC metro area? They want a cushy government job because they can't get fired, because they can make more money. And then when there is a government shutdown, they're given back pay. So you hear all these you have all these hardcore Democrat journalists that don't do any halfway balanced coverage, bashing Trump about government shutdowns and things like that, like the government employee is going to go bankrupt or something like that. The government employee is going to get all their back pay, okay? The government employee is going to get their back pay. As soon as they get back to work, they start getting all their back pay that they were not, the paychecks they were not getting while the government was shut down. The mainstream media around here bribes for stories. There's articles that have come out in the Washington Post and elsewhere in the last couple years that Nationals tickets be on home plate, Capitals tickets, nice perks for leaks and stories. And people barely batted an eye. Jim says as long as we sheeple pay taxes is sustainable. That is part of it. The other part is world reserve currency, U.S. government. So the bubble here in DC is totally divorced from reality. The amount of speculative investor capital has left a lot of other major metro areas in the U.S. Wolf Richter covers the San Francisco and Silicon Valley metro areas extensively for real estate, and he said that real estate market has cooled off. I'm willing to make an educated guess that a lot of that speculative capital that was in Silicon Valley has come here to the DC metro area like crazy. Thanks for the super chat, Justin. I appreciate it. Take a look at listener questions and comments. Blake asks, so housing starts are beginning to build more houses? Yes, and permitting. So we had a massive increase in the last 12 months, 40% increase. I think in the last 12 months from one of those articles, can't remember which one. Yeah, 40%. According to the report, housing starts soared 40.8% on a year-on-year basis in December. Housing starts spiked 16.9% to a seasonally adjusted rate of 1.608 million units last month, highest level since 2006. So I think we've had a 16.9%. The 16.9% increase is not year over year, because the year over year basis one was 40.8%. So I think the 16.9% was just in the last month. Welcome to dystopia. And this scheme with higher real estate prices, It's all about tax revenues. At the federal level, it's capital gains tax. When someone sells the house they didn't upgrade at a much higher price, federal government gets big capital gains tax revenues. And then the state and local governments get enormous property tax hikes at higher real estate valuations. And this is how you have stories of people who bought a home in the 70s or 80s, didn't do much to the home, and then when they're ready to retire, the home went from being like worth like 70 or 80,000 to 600 or 700,000, sometimes even over $1 million, depending upon the metro area. You live in a van down by the river. Is that a song? Or are you hanging out with Suicide Van, that troll that was annoying me yesterday? God, that guy was annoying. He wrote me a whole paragraph. What an idiot. Wrote me a whole paragraph complaining about how I complain. What a big baby. Gotta love people that say that I complain and then write me a whole paragraph complaining. Look up Chris Farley for the living in a van reference. Is that from Black Sheep? Buy 100-ounce silver says few hotspots like San Francisco, Seattle, New York. From what I've heard, Wolf Richter tracks this on the Wolf Street. He tracks this way more than I do. I read his articles and listen to his audio podcast when I have time. But San Francisco and Silicon Valley are cooling down a lot. So that speculative capital in those areas for real estate is moving. Seattle is still going pretty strong from what I'm hearing. It sounds like New York speculative capital has slowed down a lot. When you have an enormous amount of luxury condos that were built in the last 5 years and half of the condo units are empty and unsold, it's a big red flag. It's Miami 2006 levels. It's very similar to what happened in the U.S. 2005, 2006, 2007 in Miami, Las Vegas area, California, Arizona. Although the data that I've seen lately from the Schiller Home Price Index that was tracking is rents are actually rising the fastest in the Phoenix area. Jonathan asked, what else is undervalued besides silver? It's a good question. In my opinion, uranium is undervalued, but the problem is uranium, there's a lot of risks. So it's tough to know when the bull market will restart. Uranium is undervalued. I think it will still require more patience. There's not a lot of things that are left undervalued. Sandstorm Gold was very undervalued a year ago. It was still like $4 a share, under $4 a share, a little more than a year ago. It was an unbelievable bargain back then. I wish I'd bought more shares. And I have a lot of shares. I wish I bought more, but oh well. I covered nickel over the summer. The problem with nickel, Jack, is nickel is a byproduct in a lot of mines. So there are very few pure plays on nickel. And to get exposure to nickel, you're normally going to have other base metal risk. You're also taking mining risk, and most of these mining companies are really crappy businesses. A mining company is not a good long-term buy and hold because they are really, really crappy businesses. You do not want to be holding an individual mining stock for 10 years or 20 years. In fact, the mining industry is so difficult. There's so many moving parts. There's so many risks that the retail investor does not understand. A mining company could be doing very, very well, and in 2 years or 3 years later, something could change. One or two things. All it takes is one or two things to change, and the mining company could be facing bankruptcy. And that's what happened with New Gold. With Rainy River and some of the other problems, New Gold went from the absolute darling, one of the most respected mid-tier mining companies in a long period. I made a lot of money speculating on New Gold years ago. I got 400% returns in New Gold in under 2 years on those shares. And I sold out before it collapsed, but they bought Rainy River and they put a lot of capital in it. It did not come in on time and on budget. The project economics were nowhere near what they thought. It was an enormous money pit, and it almost bankrupted the company. They cleaned house of the CEO, and I think the board of directors got cleaned house too, or most of them did. So they went from the absolute darling of mid-tier mining companies to almost bankrupt in about 2 or 3 years. So that's why it's dangerous. One of the best case study examples recently of why it is dangerous to buy and hold a mining stock, an individual mining stock long term, if you don't check it and don't know what you're doing. That is not financial advice. That is a cautionary tale with a case study. Franco-Nevada is, Magic Marker says Franco-Nevada seems pretty good. Franco-Nevada is good in my opinion because they do not mine. They do not have any of the risks of the mining companies. If Franco-Nevada were to have a couple royalties or a couple streams with some problems, the business is not in jeopardy of bankruptcy. Okay, well, I think that's it for right now. I want to thank everyone for their time for listening to this. I try to put the pieces to the puzzle together, but there's a lot of evidence that the real estate bubble in mainland China is starting to slow down, and a lot of warning flags now here in the U.S. with the amount of mortgage-backed securities, jumbo mortgages, and also home equity loans, the amount of radio commercials that locally here in the DC metro area with home equity loans. The company is Westland Financial, I think, that's running the radio commercials nonstop. I looked them up. They're out of California. So I don't know if they're like any of the shady companies like Countrywide, but I found it interesting that a California mortgage financial services company is running radio commercials for home equity loans nonstop around here now. Also on Fox News, I saw that for military current and former military, there is a mortgage finance servicing company offering people like no money down payments for mortgages and other interesting similar products to 2005, 6, and 7. Durf, unfortunately, I have not looked at Keith Giro's take on jumbo mortgages. So thank you for the super chat, but I have not looked at that. Again, I want to thank everyone for listening tonight. Thank you very much for the super chats, the 2 super chats, and thank you also to my over 200, almost 250 now Patreon account contributors. Hopefully it will be 300 in the next 12 months, hopefully less than 12 months. And thank you very much to my dozen or so monthly PayPal contributors, and people throw me a tip once in a while. I also take cryptocurrencies. The top 6 ones can take a crypto donation, a tiny one, if you want to chip in and help me so I can focus on unique research, content, information, education, and analysis like this one. And hopefully someday I'll raise enough money so I can build my financial education company, which will be very, very good for a lot of people. So you can learn stuff like this in a virtual classroom format, easy to understand, rather than going to all these different websites. It'll be on one place.